Now let's go over this super common question that I get with clients, and that's what happens if I miss an estimated tax payment? Well, there's actually 4 different things that the client could do, and each one would result in maybe some penalties or a lot of penalties. The first way is make the payment now. So right when the due date comes up and they miss that payment, the next day is when the penalty starts accruing over and over, right? And remember, it's 7% for the whole year, so 7% divided by 365 days per day, that's gonna be the penalty that they're paying, which is still better than missing the whole payment and paying at the very end of the year. So at least they will pay a little bit of penalty, and that's better than paying a big penalty later on. So just make the payment late and just pay that little bit of penalty that accrued for those number of days that we were late. Now the second option, which is actually very common, especially with the first quarter payment, is that clients completely miss the first quarter payment, and then now when it comes June, they want to make the June payment, but they realize that they never made the first quarter payment. So what can you do? You could probably just double it up, meaning that you make the first quarter payment and the second quarter payment. And you would only pay penalty on the first quarter payment up to the date that you made that full payment, right? So making sure that clients understand that they can double up and just pay that little bit of penalty for one whole quarter instead of missing a whole payment and just ignoring it all and then paying that first quarter payment at the very end of the year or at time of tax filing, where they're gonna accrue a lot more interest or a lot more penalty, right? So making sure that clients understand that, hey, you can double it up, you will pay some penalty, but at least it's not gonna be a big penalty if you were to wait later on. The third option is don't pay anything. I have clients that will miss the whole year's prepayment schedule and not pay anything, and then I just calculate the penalty on the tax return and they just pay the penalty on the tax return. So that's if they understand that they got hit with penalty, or maybe it's the first year of getting hit with penalty, because maybe before they were always getting refunds and then now income is shifting to maybe more self-employment income, and this might be the first year where they're getting hit with the estimated tax penalty. So we just pay the estimated tax penalty on the time of the tax return, but letting clients know that if their taxes are continuing on the way it is as self-employment income or something like that, then they're gonna keep on hitting this estimated tax penalty unless they make these prepayments. So letting clients know that, hey, if you're okay with just paying the penalty, we could just calculate it on the tax return for you and you just pay it on the tax return. And the fourth way, I call it bill me later, meaning that the IRS is just gonna send the bill to the client directly later to make the estimated tax penalty. And usually for this one, I only do this when for some reason it was an off year where the IRS might have done some quarters at a lower interest rate and another quarter at a higher interest rate, and my program doesn't really know how to estimate that yet. So like say for example, COVID year, there was a lot of changes within the IRS and the penalty calculation. So for that year, I actually didn't run any calculations at all. I just thought it would be easier to let the IRS run the calculation themselves, and then they'll just send a bill to the client later. So for one of those years, I tell the clients, hey, I'm not gonna calculate the penalty for you. Just expect the IRS to send you a bill later on with the penalty. And most of the time, IRS is right. I actually never seen IRS being wrong on the estimated tax penalty itself. So making sure that client understands that, hey, when we file a tax return, whatever you pay is just the taxes itself, and then the IRS will send you a bill like 3 or 4 months later for the penalty and maybe some interest on that. But I think that's one of those cases where only if there was a confusion with IRS or some big changes in that year when it comes to calculating penalties, then that's when it's probably easier just to have the IRS do it. But that's also a possibility, is that client knows that the IRS can send them a bill later.